Markets have been pretty crazy this year, and that's just following what was a pretty solid January, really turned into a pretty negative February, March. And we've recently seen a little bit of a tick higher in markets, but still a ton of volatility, a lot of things going on, a lot of dynamics underneath the surface. And that's what I want to break down today. What's going on? Kind of what are we looking forward to, where we've been and where we're going.
Yeah, the past 4 or 5 trading days have looked like we're trying to make a rebound, but year to date, the S&P is still down about 3.5%. NASDAQ's down about 6. Both of these indices have entered correction territory, meaning they're down 10% from their all-time highs that we experienced, Q4 of last year. And so this is a pretty big pullback. Kind of felt like the market needed that bit of a reset in order to kind of start moving higher again.
Yeah, they call those, 10% pullbacks, official market correction. It really seemed like we needed to hit that level before markets could kind of find a near-term bottom at least. And we've been telling a lot of our investors, a lot of our clients that, we expect things to be choppy right now because the market is under so much political influence. I mean, and we're going to get to the tariff talk and what's going on with the administration, but the Trump administration is moving fast, breaking things. It's having implications for markets, and that's been a lot to follow. I think just kind of going back to you're mentioning the S&P and the NASDAQ returns. I think something really interesting is that the equal weight S&P 500 is actually about flat or slightly up for the year now, which shows that we have seen that broadening out of the market rally. We talked about this on a podcast a few months back, how we kind of anticipated that 2025 would see a broadening of returns. And it's been the non-mega cap companies that have actually held up pretty well so far this year.
Yeah, no, that's a good point. That's where a lot of the index corrections come from, is those top names. And, it's kind of good to see our equal weight theory kind of starting to play out. And so you mentioned tariffs, and I'm going to grab my notes for this because there are a lot to get through. But just kind of to give us an idea of where things currently stand, because it's been constantly in flux one way or another. But so what we're currently looking at that's been instituted right now is a flat 20% on all products from China. That was initially 10%. It was ratcheted up to 20% a couple of weeks ago. And then where we stand on Mexico and Canada, which have been most of what the commentary has been about. We're currently still 0% tariffs on all USMCA agreement complying products. And so that's the agreement that Donald Trump negotiated in his first term with Mexico and Canada. So everything that still falls under that and complies with that agreement is tariff free. So that is realistically anything or most anything that these countries want to qualify under USMCA, but whatever they institute, like Canada, reciprocal tariff, or not even reciprocal tariffs, their own tariffs on our goods, then those goods are no longer complying. And certain things that you have to do to comply with it, manufacture it, mostly in Canada or Mexico, not import it from China and then just pass it through. That would be a non-compliant good. So 0% on all of that. 10% on Canadian energy, 10% on Mexican and Canadian potash. That's a fertilizer that we import pretty frequently. That's why it's getting a cut from the 25% on all non-USMCA complying goods. So that potash can still be imported under USMCA tax-free, but if it's not USMCA compliant, 10% on that. And then finally, that 25% global steel and aluminum tariff. That's big for Canada because most of our refining capacity is actually in Canada, and it kind of crosses back and forth. But we import most of that from up there.
Yeah, and I think talking about Canada and Mexico specifically, I think that's where the market has a lot of this consternation, a lot of uncertainty and worry, because ideally we want to have very close trading relationships with Canada and Mexico. We've already talked about tariffs to a fairly broad extent on prior podcasts. But what we want is really good trade relations with those two countries. And I think we're starting to get to that. I mean, we've seen a big shift in the administration as far as the communication goes with those two countries. At first, we were getting lots of tweets, Truth Social posts, a lot of flip-flopping as far as tariff policy goes. And then as of recently, we really haven't had a lot of news. It seems like the administration's really trying to negotiate, being very thoughtful about how they're going to present these tariffs to the world and to the markets, because it's that just that alone, just not having changes in tariff policy every day has really helped financial markets, steady themselves. Like we mentioned, we've had this upward lift in markets as of late. And so I just think having more clarity around that communication and being a little bit more, articulate with all of that is really helping financial markets. Now, you mentioned the tariffs that have been imposed. We have to mention that there are tariffs that are coming down the pipeline right now that are still in the negotiation process. But, Donald Trump has set a date of April 2nd for the reciprocal tariff policy, meaning that any country out there right now that has a tariff on our goods, we're likely to put a similar tariff on their goods. So a great example is European autos. We don't really have much of a tariff on European cars coming to the United States, but they have, fairly sizable tariffs on US automakers, sending their cars overseas, which is why you don't see a lot of, Ford, Chevy, cars and trucks over in Europe, but you see a lot of, Audis and other European auto brands here in the US.
Yeah, and that's a great example to talk about what victories the current administration has seen from the tariff policy. Obviously, there are puts and takes here, but on the positive side of it, autos were a big thing. We've seen EU reduce their tariff on US cars being imported over there dramatically. Like they reduced it down to, I think, 3%. And so that way reciprocal tariffs, okay, well now they're only subject to a 3% import tax versus it was going to be like 10% or even higher under the old, tariffs that they had imposed. So that reciprocal tariff is kind of a twofer. It's one to, put us on an equal playing field, but also, get some of those concessions. And speaking of concessions, the other major victory coming out of all this was really an immediate victory with Mexico and Canada. As soon as Donald Trump proposed tariffs at all, he saw a very rapid movement to strengthen border security from both Mexico and Canada. And that's a big policy point of his. And he saw, improvement on that on day one. And so, I think that's worth calling out, as the tariff policy is causing a lot of pain and, difficulties and negotiations. That's not always fun, but, it is driving some results.
Yeah, and I think that's what you want to get out of this tariff negotiation phase is get those concessions and then get back to a free market, free trade environment, because these tariffs that are instituted right now aren't super tenable for the long term, because we are very reliant on Canada and Mexico for trade, and we want to have good trade relations with them, which is what brings in the drawbacks to these. You mentioned some of the victories. On the other side of that coin, I mean, we have seen a ton of uncertainty, a ton of confusion in financial markets. We've seen a pullback of deal activity because companies aren't sure where to place their investments when they don't know what the final tariffs are going to look like on their goods or the goods that they're importing. So it's just very hard to make those big business decisions. We also saw a lot of manufacturers really front load a lot of their buying before the tariffs got instituted, which actually led to increased prices for those companies, because if you're trying to get a lot of inventory in immediately, those shipping rates are going to be more expensive. If you're putting rush orders on things, that's going to make those items more expensive. So it's creating some issues within the global ecosystem, the global economy. And what you want is that to only last for a certain period of time. Now, if we can continue to get those concessions, get a more fair, more free trade policy throughout the world, including, of course, first Canada and Mexico, but also the European Union. That would be a huge win for the administration and a win for investors, because then you get through this really confusing period right now, this period of uncertainty, into greater clarity and a better operating environment for corporations.
Yeah, and I think that's a great point. Is from our perspective, the economist point of view, it would be great to see these tariffs being used as a tool to enable free trade throughout the globe, and address those kind of imbalances that we've seen, as we mentioned on previous podcasts. Other countries, by and large, actually exclusively have higher tariffs on us than we have on them. And so seeing some of those get wound back would be a great result of this, just looking at it from a true, just pure economics perspective. If we can just use this short-term pain to lower the overall amount of tariffs out there, then that would be great for the global economy as a whole. And then speaking of the market correction, the equity markets have had a reaction to all of this. But something that's really interesting is we haven't really seen the same in credit markets. So credit markets are notoriously, it's the smart money, as people call it. They're the first to project any kind of economic uncertainty. You see spreads widening. You see, concern through forecasts, broadcasts throughout the credit markets. And we're not seeing that right now. Corporate credit, both, investment grade and high yield or junk debt, those spreads haven't really widened through this period.
Right. I thought that was the really fascinating thing to look at in credit markets, because equity markets are pricing in roughly a 50% chance of recession right now, or a little bit less now that we've had this uptick in the market. And that's really just a function of how far have equity markets dropped over what's a typical drawdown during a recessionary period. We've dropped somewhere in the 10 to 12% range. A typical drawdown under recession is, 20 to 25%. That comes out roughly to a 50% chance of recession. It's pretty basic, kind of simple-minded math. But credit markets, you're really talking about the spreads on those corporate bonds, whether that's investment grade, like you mentioned, or high yield. And just for our listeners, a spread is basically what you're paying over treasuries. Well, the riskier the debt, you have to compensate an investor more by offering a higher spread, a higher percentage yield over those US treasuries. Well, we haven't seen those interest rates really expand that much for corporate credit, which means that the credit market and those credit managers, who are notoriously very conservative. I mean, if you're a credit manager, you're thinking, what are the ways that I could lose my money? Not how am I going to make the most money? It's really about being conservative, being on the defensive. And if they're not so worried about the way that spreads are moving or the way that the market is moving right now, they're not really pricing in a recession. It is a positive indicator as far as how the fundamental backdrop of the economy looks right now.
Yeah, no, and that's a really fascinating thing to keep an eye on, because we're in a different situation than most big pullbacks or real concerns of recession. Turning back to equities, something that we kind of mention a lot, but is a very important part of the story, is the AI sector. Big tech, they've, like we mentioned earlier, they got hit the worst out of all of this, mostly because they had gained the most leading up to it. And then the DeepSeek realization caused a lot of fears about CapEx. But, just as an important update, we have seen continued strong CapEx numbers out of hyperscalers, out of Nvidia itself, making huge investments on, being able to produce more chips in the future. Just at their GTC conference, had a bunch of pretty remarkable announcements and a long-term roadmap that looks like they're not planning on slowing down anytime soon.
Right. I think the fundamental backdrop for most of big tech, especially in the AI space, looks pretty strong. And I thought some of those insights from the GTC, NVIDIA's GTC conference were interesting because there was a lot of talk about how power constrained the AI industry is, meaning that they are building that infrastructure as fast as they can, but it's the power that's going to be the limiting factor in all of that. And so being able to be extremely efficient with your chips is very, very important. Technological advances are improving both the compute power of the chips, but also the power efficiency, which is a huge benefit to those AI companies, to those hyperscalers that are building out that infrastructure. And what we've seen is that these companies are not slowing down on their spending. They're not slowing down on their data center build out, which gives us pretty good confidence as investors that, yeah, I mean, we're going through this choppy period, like we mentioned before. It's a lot in regard to tariffs. But if you look at the long-term fundamental outlook, it still looks pretty strong for these companies, which I think gives us a lot of confidence in those that we're investing in right now.
And something interesting that I want to add is that tariffs have, driven a lot of the market uncertainty as a whole. But when the tech companies are the ones getting hit, these are domestic US companies producing predominantly in the US. Yes, Nvidia supply chains use, Taiwan, TSMC being the largest, semiconductor fab in the world. And a lot of that is moving to the United States, but most of these companies it's intellectual property is really what they're selling at the end of the day, services, IP, things that aren't subject to tariffs. And so for them to be getting hit the hardest based on tariff news is kind of interesting to me.
Yeah, I think that's interesting, certainly. And I think another part of that is the earnings expectations for big tech, for AI, but also as the market more broadly, because whenever you're trying to look at the market as a whole, call it the S&P 500, and you're trying to make projections for the year, forecasters are going to look at what are you paying for the number of dollars of earnings, or your, typically referred to as your PE ratio, or a forward PE, being how much am I paying now for the next 12 months of earnings? Well, forecasters have kind of projected on average about $270 of earnings per share on the S&P 500 over this next 12 months. Well, what we haven't seen is a lot of revisions downward in that yet. We haven't really seen much movement in it. And companies have been giving, I'd say, conservative forward guidance, but we still haven't seen forecasters or analysts really rein in that 270 figure yet, which means that the S&P is kind of trading somewhere between 20 and 21 times on a go-forward basis after this most recent pullback. Well, a lot of market analysts would say that this is, much healthier than the kind of 23, 24 forward earnings that we're looking at, before the pullback. We've had episodes talking about why a higher multiple we think is justified on the broad market just because of how much tech, how much growth is leading the S&P 500 now. But regardless of that, I think it gives investors a little bit more confidence to buy in here now that you are looking at a lower forward multiple. And we haven't really seen major revisions to that EPS number. So if we're able to hold up within that range, I think it's healthy. It seems like we're forming a base right now, which is going to give confidence to retail investors, institutional investors. And as long as we're making progress in the tariff area, in the tariff arena, then I think we can resume a forward rise in markets on a go-forward basis.
Yeah, no, that's a really good point. And, one more kind of victim of economic uncertainty that I want to turn to related is M&A activity. It's something that we all were expecting to really pick up with this new administration. The old administration, Lena Khan at the FTC, really was not a fan of M&A activity at all. We've had episodes talking about it, blocking, handbag companies from merging, like luxury goods and just things that you wouldn't really ever think of protecting the consumer because Hermes can't be the same parent company as Louis Vuitton or something. But so moving into the new administration, everyone was really optimistic that there's a bunch of pent up demand for M&A that hasn't been able to like go forward in the market. But we haven't really seen that come to fruition for really two main reasons. One, the economic uncertainty that we've been talking about throughout this whole episode is that when people aren't sure what future supply chain looks like, what future demand looks like in the economy, they're not ready to go sign billion-dollar deals and, kind of take a step out there and put themselves out on a limb to, grow their company in the future. They're just kind of waiting and watching. And then secondly, the new administration with FTC, they're not ready to issue just blanket approvals of M&A deals. They've signaled that they're still going to take a methodical approach, certainly being more amenable to it than the old administration, but not just blanket, everybody do whatever you want. We're still going to look at this and, take it slow.
Yeah, I think a targeted approach is pretty prudent there. And I listened to the FTC commissioner on a recent interview, and he was saying that what they're going to do differently is instead of waiting to go against a deal, they're going to look at these M&A activity, these deals that are crossing the table. And if it looks like something that they believe is not in the consumer's best interest, they'll go ahead and file against that early on in the process, or they're just going to leave it alone. So you're not going to have this situation where a company is 1 year into a merger and then the FTC says, oh, actually, we don't like that. You're going to have to, cancel that if we win the suit against you. It's going to be, hey, you just started this M&A process. We don't like the deal. We're going to, cut it off at its knees now, which, may not be the best situation for that company, but it's much better than the costs that are incurred far down the road once you are well into that merger activity. Because if you've already essentially combined your businesses, it's much harder to walk that back than to know right away, okay, the FTC doesn't like this, or hey, the FTC is leaving us alone. This merger is going to be fine.
I'd really hate to see the legal fees and investment banking fees that were incurred between Tapestry and Capri, those luxury goods makers I was referring to earlier, over that, 9 months, year that they were in talks to get that merger done. So certainly cutting that off on the front end is going to save people a lot of time and money, and investors too, because people were playing the merger arbitrage game of what the price action looks like between the two when they merge, and that's just a whole bunch of money tied up in markets for no real reason at the end of the day.
Right. It's interesting that you mentioned the merger arbitrage, because that's a very typical hedge fund strategy, which when it works 90% of the time, when those mergers close, you get those few dollars worth of benefit, but it can reverse itself in this kind of situation where the FTC goes against the deal. But I'm glad that you brought up hedge funds in the conversation, because I want to talk about the overall ownership trends that have been going on through this market downturn. And what I found really interesting is that it's not a lot of retail traders that are selling out of this market. I think a lot of retail traders, like the clients that we work for and work with, they're really holding on to their positioning. I mean, we talk about in a minute, we will talk about the way that we're investing around this. It hasn't really been a situation where, hey, I just want to totally get out of the way. Let's sell, let's reduce our positions in a really broad-based fashion. It's, hey, I think this is going to be a lot of short-term noise. Let's see how it pans out. We're long-term investors. And bringing it back to the hedge funds, is they're the ones who have really decreased their positioning through this most recent cycle. And it's been a lot of hedge funds bringing dollars off the table that has led to this downturn. You've had more institutional funds like hedge funds pulling dollars out of the market because they are trading on a more short-term basis, which is very frustrating for us as retail investors, as long-term investors, because the short-term noise isn't necessarily a good indicator of where things are going to go long-term, but it causes discomfort whenever you're watching the portfolio on a day-to-day basis. Now we have more confidence over the last week or so, but it's still something that causes a lot more volatility than is maybe necessary in the current market.
Yeah. And so being those long-term investors, like you mentioned, what we're doing differently is we are, shifting a little bit to a more conservative approach. There are a lot of conservative, ideas that we really like in the market right now, but it's not a sellout and shift like we're seeing in hedge funds. It's let's trim around the edges, position ourselves a little bit more conservatively so we can weather the volatility in the interim period better. A lot of things we like for that. I mean, fixed income and certain portions of fixed income, like we talked about earlier, spreads haven't really widened to compensate you for certain risks. So you really have to, kind of pick where you're going at in fixed income, structured notes, defined parameter investments, like we've talked about on previous podcasts. There's just a lot of options out there to position ourselves a little more conservatively, to take some of that volatility down, just to ease the ride for a lot of our clients. With still good return prospects, but we are holding conviction in our top names, in the companies that we have done lots of research on, due diligence on, and know that they're good companies, that it's the price getting battered down. But at the end of the day, it's still the same underlying really strong company that's growing earnings, that's growing cash flows, that's returning money to shareholders. And that company is not inherently worth less just because the market is trading down for a few days.
Absolutely. I couldn't have said that better myself. I think the important part is through all of this, through any situation where you have a market downturn or even a market upturn, if it's a really short-term kind of period, is you have to separate the signal from the noise. What I think we've seen lately is a lot of noise without a ton of signal, which creates, like I said, this uncertain environment that investors just inherently do not like. So you have to look to the long term. And we're long-term investors. We invest our clients on a long-term basis, a year plus. And so what happens in a few weeks or a couple of months shouldn't change your entire strategy when it comes to your investment positioning. But I will say, kind of to your point, is that the benefit right now is that with interest rates at a higher level, you have these other options. Pretty much post the global financial crisis up until, call it, through COVID, you didn't really have a lot of alternatives because interest rates were so low that your fixed income wasn't yielding a whole lot. You didn't have some of these derivative investments that were offering you a whole lot, and you were kind of just stuck with what was going on with equities. Well, right now you do have a lot more options. So what you can kind of do is, you barbell it with, hey, I'm going to look at some of these, fixed income and fixed income like investments on one side, and the names that I like the most in the equity market on the other side, combine that, make a beautiful portfolio that's going to last a long time. And then especially once we ride out the short-term noise with the tariff situation, we think equity markets will resume their rise. I believe that we're going to finish the year higher on the S&P 500 than we did when we started the year. But we're also not just S&P 500 investors. We like the companies that we're invested in. And I think if you just look at it from a long term, we still have a positive economic backdrop. The market, the data underlying the market right now is positive beyond the tariff situation. So if we get through some of the short-term noise with pretty good outcomes, I think the markets can go higher.
I certainly agree. And, one thing that we've been trying to take advantage of through this period is a buying opportunity. There has been money on the sidelines, new money coming in, whatever it is, having that cash buffer, being able to deploy it right now. It's in my personal opinion, not a bad time, because we're getting pretty good deals on companies that, 6 months ago were trading, 10%, 15% higher, even more than that. And so if you liked Nvidia at, 130, you got to love it, sub 120.
Well, it's going to be interesting to track with you. Hunter, thanks for joining me on the podcast today.
Yeah, thanks, Victor.